Hey folks, welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Swing Trades Using Options. Before I get on with this, I want to talk to you folks real quick. If you have a light bulb moment, please smash that like button for me. It basically tells these little bots or these crawlers to go out there and find somebody like you to share this information with. So that really does help. Comment throughout this video because I will be looking for you guys to help drive this content. If you have any questions, comments, throw it over there. I'm not going to move on before I make sure you guys are clear of concept, all right? So make sure you're commenting over there. All right, let's get on with this. It is swing trades using options, folks. So with this, what we're going to do is we're going to go in and look for an opportunity in the market. Today's directional assumption is bullish. Last week we used the bearish one. Remember, we used it on IBM. That worked out really well. So this week we're trying to find a bullish move. Might be a little bit more difficult with today's market action or the last couple of days. A lot of uncertainty going on in the markets. But with this trade here, you guys will be able to use options. Limit your risk versus going out there and just swing trading with a stock, ETF, or future, folks. This is the way to really trade swing trades, and that is in using options. You can limit your risk, limit your margin. I mean, who wants to put up full boat for something when you can put up a quarter of the money and still get the same risk reward parameters you would normally get? And I show you how to do that in some of these videos. Today, we're going to be doing the Toro Loco, folks. So this is the crazy bull spread is what we used to call it on the floor. When we would hear this getting quoted, it was immediately somebody would scream out, the Toro Loco, or many times half the pit would be screaming it out once they heard it quoted, because it is combining two bullish spreads. One is going to one is going to get you a credit that pays for the debit spread. The debit spread is going to be the long call spread there. So we're going to use a short put spread to pay for that call spread. I'll show you how to do this here in a moment. Something I did forget to mention is I try to build from simple concepts to real life examples. So that's kind of what I'm trying to do here. Get you set up with this. We'll talk about how you build out this strategy, what type of collection of credit you should get, and the strike location, something that most people aren't going to give you. They'll tell you how to set these up, but the strike location is key to the success here, folks. And I'll talk about those different strike locations and how you can set it up appropriately throughout this video. All right, so the Toro Loco, the crazy bull. And before we get there, though, we have to come up with our directional assumption using swing trades or using setups that we find for that type of swing trade. I just noticed the dictaboat in the background. Yeah. Got him to sign a piece of paper that I printed out right before I knew he was coming to an event I was going to be at. He was kind enough to sign it for me with no headache. All right. So first off, though, what is swing trading? Really what we're trying to do is capture a momentum shift in the market. It doesn't matter if it's bullish or bearish. We're just trying to catch that move off of maybe a support and resistance. And throughout this video, I will show you how I come up with some of my support and resistances as well. All right, so let's break this down to a simple concept. Really, when we're looking in the markets, folks, what are we doing? We're looking at a chart that might be moving to the, I should say, to the upside or to the downside, right? Sometimes it's market neutral. Got my thing in the way there. As a matter of fact, let me make this big so you guys don't have to stare at my mug the whole time. Is that better? You guys like that better? Smash the thumbs up if you like that. All right, so what we're talking about here is the directional moves that we're looking for in the markets. And how many do we have? 3, right? The one directional move we have is bullish. Market's moving in an upward direction, right? There's a market neutral. Sometimes those are a little bit more difficult, but I've got one of the best examples of market neutral underlyings there are. And then sometimes we get that bearish move, which we're starting to see some of these stocks in the S&Ps, NASDAQ show some bit of weakness here as of recently. But when we're looking at an overall market that is bullish, what do we see within that? We see like ebbs and flows in the markets, right? Sometimes they don't hit all of the tops, but you see those ebbs and flows happening throughout. Sometimes they're a little bit wanky, but that's ultimately what we're looking for, is those different market actions, right? So now we've got the overall gist of it. Whether you're using candles or not, you can kind of see these ebbs and flows in the markets. And what we try to then do is draw a support and resistance. Some folks use Fibonacci's, some folks draw them in there. I have a tendency to use both. I see where the support is, sometimes not lining up on Fibonacci's. Now, why do I use Fibonacci's and these others? Because listen, I don't know that the overall market is associated to a conch shell or a leaf and all of that stuff like the Fibonacci mathematical process is. But if enough people are using it, it comes to fruition is what I'm looking at. But I also go in my own head and say, how can I draw a line to touch as many of these lines as I can? So my line might be a little bit different sometimes. And it's usually going to be a little bit tighter than what maybe some of those others are, okay? So idea is, if you're higher risk tolerant or seeking more risk for more reward, then I would go a little bit tighter where you get most of those hits. Now, you aren't getting involved right here when it comes down and hits this support level that I drew in there. You would wait for it to re-enter that area if you are going to those tighter locations, all right? So, and really, actually, that's a rule of thumb across the board. If it pierces through that line, get out of that trade, wait for it to re-enter the zone, all right? And then, so ultimately, we've come up with the overall trend that's bullish, bearish, market neutral, right? And then we've come up with our support and resistance areas. We need to find those support and resistance areas because those are the indicators that we need to have our radar up to find a momentum shift, because we usually see those momentum shifts happening at these support and resistance levels. And the last thing we're looking for is the pattern within the trend. So sometimes, like in this case, we've got a bullish trend, but the market has reverted into a bearish pattern. That's what we want to trade off of. And we're looking for it to come back down and hit the bottom trend area, or the bottom support area on that bearish pattern reversal. Here we've got a neutral pattern with a shift, and we've got a bullish pattern within that overall neutral trend. And again, bearish trend, and then we've got to revert. We've got a little bit of a bullish move here inside of a bearish trend. That's what we're trading off of. So don't get confused on the overall 52-week move that we've been seeing here. What we're looking for is that 52-week average is going to show us where those support, or the 50 back is going to show us where that support and resistance is. And when we found those support and resistance based off that data, we're looking for the pattern move into a bullish, all right, or a confirmation of a bullish move here. So, for instance, now let's get on to some real life examples. This is a really old example of IBM, but bear with me. We'll update it as we go along here. But I love IBM because I've been trading it forever, folks. And the reason why is because it's never gone anywhere. I hated it when I first started trading it because I was trying to make money off of these moves to the bullish side with my stock, but it'd get up to about 110 or something like that and roll back over to 95. Now, it's a little bit higher now, but when I'm talking in the 90s, 1990s, folks, it was trading in a similar range between 110 and basically like 95. So it'd get above 100, I'd start selling some calls or stuff like that. That's how I got involved in trading options. And then it'd get called away from me possibly, or I would want to add some, I'd start selling some puts to take advantage of those collections. If it got put to me, I knew I was getting it put to me at around 95 and called away at a 110. Now we're looking at getting called away at 132 or something. Yeah, right around 132 would be worst case scenario for the most part, and then getting long at 116. So trying to capture it on those support and resistance levels. And since I got a little ahead of myself, which seems to be the case today, we kind of look for those overall. We can see it's a neutral trend, right? But you can also see when it comes up to this area right here, which happens to be a Fibonacci, that it loses that momentum to the upside. And then it gains a lot of support right here at around that 116 area. So those would be things that I would be looking at, especially for you guys that are newer traders, want to get involved in maybe some swing trades, right? This is, I'm not going to say it's always going to be, but this is proven in the past to be one of those that really likes to stay range bound. So if you're looking to get involved in trading or swing trading, I would suggest folks to really consider thinking about using IBM for those types of swing trades because it gives really good indications. For instance, when we were looking at this in the swing trades, we were selling calls because of volatility at the 137 level. I was selling calls up there. And it was because I had high volatility. The other thing was I was like, hey, it's never really broken above 137. Everybody hates it. So that's a pretty good location to get above and have a trade. Now, why did I pick this mark rather than like a previous one that came up close to it? Well, it's the way that this candle looks. All right. So there's 4 really key candles I want you guys to start looking for. And it doesn't matter if they're red or they're black. You just are red or they're green. It depends on how you set up your charts. But you want to look for these when they are approaching those support and resistance areas because that tells you where the bulls and the bears are battling it out. All right. These types of candles that I'm about to show you tell you when the bulls and bears are battling it out and one of them is going to lose momentum. So on these types of candles, we look for it for the setup of the pattern reversal. All right. So which means that we're looking for it to change the momentum in the market. So we could look at one that is like this. All right. Big, heavy at the bottom, a hammer at the bottom there. That looks very similar to this one that I drew it, I circled there, right? Another one would be that it looks just like this. And these are mutually exclusive. All right. They aren't, we're not talking about day by day. I'm just telling you to look for these individual type of hammers and hangman dojis. Another one would be you got a little bit of a wick at the top, okay? They've got different names, but they basically, you can see they pretty much are the same type of candlestick. Another one to look for, the 5th one, is the tombstone candle. Very rarely do you ever get to see that one, but that is a really good, strong candle for a pattern reversal, okay? So like I said, these candles could be in green, looking the same way, all right? Sometimes they're going to have a little bit longer wick or slightly in between, okay? So in a perfect world, you know, they look very similar to that at the top of a move. So those would be the first keys to look for. There's a lot of other setups that, you know, where you have the reversal here where it's an engulfing pattern and stuff like that. If it's at the top of a move, it's basically a dark cloud. So you will see some of those where if you had, let's say, a big green candle, you know, off of a move, the market's been moving higher and higher and higher. Well, if you got the next day, this is a pattern where we're talking about 2 candles combining, making a significant indicator. Whereas where I was talking about with these individuals, where that's where those bulls and the bears are battling it out. Well, in this case, let's look at it. We've got a bullish move. We don't have any bears coming in because it's strong. But the next day, let's say we opened up and we've got an opening above the previous day. So everybody's thinking it's bullish. And then all of a sudden, almost like today, the market drops and engulfs the previous day's market. So you can see that this candle is a little bit bigger and more bearish. This is a dark cloud and a very bearish pattern setup. All right. The flip side of that, you know, a red and then the green would be the engulfing pattern. All right. So those are what we're looking for on swing trade setups. All right. You have to wait. If you are newer to trading options and newer to swing trades, wait for the confirmation. All of these, everything here that I've drawn is a setup, meaning that is the trigger for you guys to think, I need to pay attention, especially tomorrow, to see what happens here. I am usually a little bit more aggressive. I'm not going to lie. I don't wait for the confirmation, which I have a higher risk tolerant trading regimen than most folks out there. So if you are aggressive and you're used to being aggressive, then I don't have any problems getting involved on the setup. Now, when we're talking about this setup, like we're looking at here on IBM, the idea is if you do not get the confirmation, which would be the red one, right? This would mean confirmation of the top, a settlement below here. So this would mean the market is turning bearish because you've got the setup candle. This is the setup candle. And then you've got the confirmation candle, meaning you are solid. It's going to roll over for at least a day or two is quote unquote the theory behind this. And then there was something else I had in my mind that I was going to talk about with that reversal. But I get involved before. If you're newer to trading, I would wait for the confirmation, because if the next day comes in and you're going to want to trade this, hopefully this gets rid of it. If you traded on this candlestick setup, then what you want to do is make sure that your exit is always out at the previous day's high there. So in a sense, if I see this candle set up, but the next day the candle comes in and starts building, right? And it settles above this previous day's wick. I don't know if you can see it kind of falling in there. Then this has broken the pattern, all right? So you would be out on that settlement above the previous day's wick there, all right? So when we're talking about exit strategies here, this is another thing that you're going to have in your head. It's not a win or a loss necessarily. It is a price above that wick. Am I pretty clear so far for everybody? Anybody had a light bulb moment out there? If you had a light bulb moment, smash that like button for me. Let me know. All right. So here's the one example that I was coming up with today. I'm looking at this as, generally speaking, a pretty bearish overall trend, right? I mean, one could say it's green, I'm sorry, but this is a pretty bearish overall trend. But what I want to look at here with this trend is it looks like that bearish trend to me has been broken a little bit, because it's gone above, and similar to what I was just talking about with the previous candle, breaking that pattern. Well, as we look at this as lower highs, lower lows, lower high, lower low, and we've got this nice candle with a confirmation off the bottom, but it's broken above this line right there. So that line would have continued that bearish pattern trade, but we've popped above that. So the bulls are starting to take control here. Now we are at this point of control, and a lot of times things will settle down there. So that would be something in the back of my head with this trade. Is it going to just sit here and hang out right here at 235 to 240? And that's just not going to be a big fun deal. But on this, I'm looking at, here we have one of those candles. It's a green basic hangman doji right there. And that's not at the bottom of a major move like this one, but we can see it rolled over, and we've got a couple of those together. So it's continuing that pattern to the upside. So I guess what I want to show you there, with these candles, when we start combining them together, they also mean something. Like when I said there's the one with a confirmation, shows you that top. Anytime you see like a doji that is kind of like this, and they're stacking up from, like a bearish move like this, all right, this, when they combine and back to back themselves, they kind of mirror themselves. That is usually a continuation. So don't get caught on thinking, all right, well, Wolfman said it at the bottom of move, we've got this, even if it's red, you know, that is still, when they back up to each other like that, that is more of a continuation pattern. So I kind of covered it up. That's what's going on right there when I clear off some of this stuff. And that's another reason why I was looking at this particular trade here, was for the continuation pattern that I was kind of showing there. Let me see if I can erase it. You can see it. I won't be able to blow it up, unfortunately. And you see how there's that like green candle, the red candle, and then we're popping off. So that's an upward move. You also got that continuation pattern kind of there. But at the end of the day, I'm looking at this to play it bullish because of the way that the market's setting up there. And it's one of the fewer things that I think have not really done very well throughout the pandemic. These chips are coming in. These truck guys are going to be able to start selling, or these car dealers are going to be able to start selling their cars and the trucks, which is their biggest seller. Something interesting, used cars year over year up 30% in value. 1 year, your used car is almost to new car levels. All right, so what are options, or why do we want to use options? Because in that situation when we were talking about IBM and I'm selling those calls way up there, remember I said we were selling calls up here at selling a call at the 137 area. That was based on that market setup. Now, I missed this move the first day and it really kind of got away from me and I just let it play out. But normally with this trade, you would want to get out, lower risk tolerant or newer to swing trading. Get out when that pattern is broken there. Now, I stayed in it and I took the heat. I thought, you know what, I will get short IBM at 137. I can't remember the last time I heard IBM was at 137. So, but I just stayed with this trade and, you know, lo and behold, we got another one of those candles at the top of a move. But this one got confirmed, right? It's got that dark candle next to it. So it allowed me to see that move, and I stayed with this trade as well or I continued to stay with that trade into a winner. But here again, if we go back in time to where that trade was, I got to remember where it is now. It's so far away. Where is that pattern trade? It's like over here. Here it is. There's the candle. Of course, I don't have my pen ready. So here's where we were talking about didn't get confirmed, got confirmed, but you can see it rolled over quite nicely. Short call spread or short calls, you'd be out of that before the earnings. I wouldn't have set this trade up as a short call in a month with an earnings cycle in it for all the reasons I've talked about, probably in every other BUM. Are you saying you want me to look at BUM? I don't know what Teramoc. I don't know what that. I don't know if I've ever looked at BUM. But again, we got this pattern at the bottom, or one of those candles here. Didn't get confirmed. Rolled over. I would not have been in on that trade to the upside because it's just too sloppy. I like the ones that look like something like that, because the next day it gets confirmed and we start rolling over. But you can see these are the next couple of days on this chart. It does look a little bit different there. But again, approaching a resistance area, yeah, it might sometimes shift like what we were seeing as the resistance areas before up here at 137, or I think I've maybe even switched the 137. This is the resistance. We've kind of punched above that. You might want to look at 144 if you have a lower risk tolerant trading repertoire. So again, looking for that rollover. Never got confirmed on this one. As you can see, there's a topping candle right there. Almost one of those tombstone dojis, but not quite. Right there, never got confirmed. So newer traders, don't jump on that. Not confirmed yet. So newer traders would want to wait for that confirmation on that next day. So you'd trade off of that trade. Trade off of the red candle, all right? As soon as it starts looking that way. Any questions so far? All right. So again, back to Cummings. I want to play this to the upside. I think this industry is starting to turn around. Cummings hasn't really been hurt a whole lot on this because if you think about it, they're building these trucks, folks. They're building them all except for one little chip to slide in there and make that thing work. They don't have them. So they're just basically building them all except for that one chip that needs to go in there and parking them out in the field. I mean, there are thousands upon thousands of trucks ready to be sold once they get a chip in them. All right, so I'm playing this to the upside. We've got our bullish move. I believe it's going to move higher and test at least this value area. So that's a target I'm looking for, somewhere around 257, 260 to the upside. Now, if I break, I'm going to look at this candle right here because I have a higher risk tolerant trading repertoire, because that's the candle that I looked for the setup. So for me, if I were entering a trade today, below this 230, let's call it below 230, I'm out of this trade because that would be saying it's rolling over. And if I got a big green candle tomorrow, then I would start rolling that out higher, right? I'm out below the previous day's candle, all right? So always kind of start rolling that. Yes, thank you. That way, all right? All right, so now the Toro Loco, the double bull spread, folks. This is an aggressive trade. Now, earlier on, we did some things that were called risk reversals, and this would have been kind of similar to the bullish risk reversal, which I said, hey, you know, if you have stock in your portfolio, that bullish risk reversal is a great strategy to add to a portfolio because you can capture that upward momentum. It gets up to that high level like IBM, and you do your you get called away because of an extra short call in that, which is a great strategy if you think you're going to get a bullish move to a level and you're thinking that's the level that I'd love to get out of, like IBM every time it gets up there. A bullish risk reversal around IBM is a pretty solid trade off of those swing trades, all right? Because your covered calls are going to be really high. But with the Toro Loco, we don't own the stock possibly, and we want defined risk. So this strategy, you know your risk and your reward when you come into this trade, which you should build it out to be as close to 50-50 risk reward as possible. As a matter of fact, your reward should slightly be skewed to your side. And I'll tell you what that entails here in a second. Let's look at building out this Toro Loco based on this current assumption. Well, I know what I want to talk about here. One thing with this trade, I talk about implied volatility quite a bit. You know, we sell premium when volatility is really high. We buy premium when volatility is really low because we know the prices are reflective of what volatility is doing. Meaning when volatility is really high at this level on this trade, I know the premiums for Cummings are the most expensive they've been almost all year, right? I'm approaching, and folks, something about volatility here is it acts like a swing trade where each individual underlying asset or stock has a volatility coefficient that it wants to stay within, all right? So if we are looking at comparing apples to apples, I have to look at IBM's volatility coefficient right now against everything it's been doing, all right? Your time frames can fluctuate. You know, I do 6 months. So I basically say anything that way, I'm not going to worry about too much. But if I'm looking at this, I can see that this is going to be up against a resistance area for volatility. But I also have some earnings right around the corner that has a tendency to drive volatility higher, all right? So I don't really know which way volatility is going to go. It could go higher. If I buy options, that would help me. If I sold options, that would hurt me. And if vice versa, if the volatility goes down, I buy options, that hurts. I sell options, that's good. But right now we have an indecision, at least in volatility. So this strategy is really good around that implied volatility coefficient I talk so much about of 50, meaning it's pretty much middle of the road, okay? This one's a little bit elevated, but everything else around it worked out quite well. But about a 50 IV% is what I'm looking for with a bullish move here. So when we're setting this strategy up, I want a bullish move happening. Now, the first go-to is the call spread. And if you guys remember watching the Toro Loco, which is the double bear spread, we started out on the put side because that was the debit spread. Same thing here on the call side. I'm going to start looking for as close to that 30 delta that I can. If you're more aggressive, you can go a little bit tighter, but I like to use around that 30-ish delta. I'll explain that a little bit more towards the end as to why the reasoning is. So I picked that one to buy. Now, rule of thumb, when you're building the strategy out, you're kind of close to about a 10% spread. So meaning a $200 stock, or in this case, a $230 stock, I went actually $20 wide. I didn't even look at the $25 wide. Why? Because I didn't have strikes for $25 going higher. And $30 wide was not working. So I come up with my spread. I can see I have to pay a debit for that. So this debit, I want to try and get paid for by selling another bullish spread, which is the short put spread, right? You collect the credit for that. So before we get there, though, let's look at the Analyze tab. You can see you got defined risk strategy, and you can make money with that move. Much more of a reward than the risk, all right, on this case. Now, but it's a lower probability strategy. Then I try to look at that and say, I need to sell a put spread in and around that same area, trying to find that 30 delta, which ends up being the 220s and the 200s. That gives me a credit of $3.20. Now, the Toro Loco is a little bit easier to build out than the Toro Loco because puts have a tendency to carry a little bit more premium to them. So while you had to finesse maybe on the Toro Loco a little bit to make sure you got a credit, you're usually pretty solid with a credit on the Toro Loco. So this is the risk reward on the Toro Loco. Yes, your risk is more, your reward is less, but your probabilities of success are much better with this, and that's why the risk parameters switch. Now, if I squish these two together, right, I'm going to get the the Toro Loco built together for a small credit. I wanted to actually have this one up because this smashes the call spread, which was for a debit, and the credit spread, which pays for that debit. Now, when you build this out, you can see if you took this together, it's basically a positive credit, right? I get a 5-cent credit. And so basically 5 cents credit. Now, because I built it out this way, I get to keep that credit no matter what, even if I lost full boat on the underlying having a directional move to the downside. This is still in my pocket. But something to note, and this is key, when you do it for a credit, right, your break even is down here when you're currently trading right here. Right? On the put side, this is where my short put is. So my break even is all the way to the downside. I have all of this wiggle room to be right. Like the underlying can go down in value and I'm still okay. I'm not losing money. So if you walk away from this with nothing else, like all you do was Toro Loco as a double bull spread and do it for a credit, I'm fine with that right now, folks. I am fine with that because if you don't do it for a credit, it is going to shift, which this is done for a credit. I went back to that well. But this one is the one I do not want you to do, because look what happens when we're looking at this. Where is it? Oh, no, I don't have it. Hold on. I'm going to have to find it now. I'm going to have to go through all my things because I got to find this picture for you. Let's see. Actually, I might just end up doing this on the, let's just do it this way. It's going to be easier. Where did you go? Give me 1 second. Sorry, folks. All right. Let me get it prepped for you. All right. Get rid of that. All right. So this is what I want to show you on the Analyze tab. All right. So this is similar to what we were looking at. The break even is right here. And that's because I got a credit, meaning anytime up in here, I don't lose money. But watch what I do when I move this credit smaller. You'll see, boom, to zero. Zero is my break even right now. But watch what happens when I go to a debit. Boom, right to the call. Your break even is all the way up here at the calls. All right. So that's why we do not want to build this strategy out as a credit. In order to be profitable, I have to make that move happen. Whereas when it was a credit, I didn't. I mean, I get to keep that penny. I mean, everybody, that's not something to write home about, right? But you're not losing money at that point. You're not paying out money. And you have more probability of being right because you have all this room for it to move, right? Here's the risk reward in a different way. Some people think about things differently. So I'm trying to come up with different ways for you guys to think about it as well. So what these are is between here and here is like a 19% chance, right? That's what that number is telling us, that it would stay there. But if I add up all of these numbers out this way, 15, 19, we got 24, 28, we could 28, 29, we're at about 30, 31, 32. It usually ends up being right around 34 is what this line says, because we're adding up all of this out there, okay? Out to like 10 standard deviations, which is likely not to happen. But could. Look at Kodak. All right, so this is where our short put spread is, right? And then that means that our probabilities of success are basically from here to here using my setup, because, you know, I was picking around, you know, I'm cheating a little on myself, but, you know, my delta is probably actually a little bit further out this way because it's a 31 delta, right? Actually, I think I was right. I'm saying the 30 delta. So even further out this way. So meaning that all of that is right. And if you do it as a debit, right, we shift that all the way up to the call side on that 30 delta. So now I only have this much to be right, which means that's a much more difficult way to play this because your probabilities of success are lower. This one is a 70% chance basically to the upside, whereas this one on this side is about a 30% chance for us to hit that strike. Okay, so stay away from the debit on this, and it's easy. You got to finesse it a little bit. Sometimes it'll pull it up as a debit, and that is usually the default I see, but it's usually only a couple of pennies anyway. We're not talking big money here on the credit. But a key thing with this break even to the upside, because I've paid off of all of that, when we're down here, as soon as, and we're right here because this is ground zero dollars, like it hasn't moved, as soon as our underlying starts ratcheting up, we're going to see this trade pay off quickly. If you guys remember the Toro Loco from last week, it paid out the next day on any type of move. And that's because we paid off all that debit we paid for, all of that, dead money, if you will. So as soon as this trade starts making money and starts moving to the upside, if we start getting this move to the upside, right? Remember, we've got a short put spread down here that we collected a credit for, right? And we've got a long call spread that we paid a debit for, all right? So if we start moving this way, what happens to a short credit spread? It starts going down in value, right? And this call spread will gain in value. So you're getting double the bang. You're going to get that short put spread giving you money and the call spread giving you money. So you're going to see profitability very quickly if you start getting that move. If it's like 30 days away when you start getting that move, it's not going to react the same. But you have basically paid off all the volatility and all the delta. So you want to go further out in time on this strategy. Give yourself room. Even if there's an earnings in there, you can give yourself the time. Those further duration options will also generally give you the better pricing for that credit as well, just as a key. We're not necessarily staying in this for the next 70, 80 days, but the way you're building this out, you're not really incurring that much more margin for giving you that time to be right. So I would suggest going further out in time, around 70 days to expiration. You're starting with that 30 delta. These are some of your keys that you're going to try to remember, right? You want to go further out in time and use those deltas that we were talking about. So if I go back to this trade, you can see that I'm using the March, and that is about 60 plus days to go. I'm not worried about theta because I've offset it, right? I sold a put spread that I want theta to hurt me, and that paid off the credit spread, so I don't have to worry about theta there. And if volatility starts fluctuating, which I'm worried about, if volatility goes up, it's going to help my call spread that I'm long, but it's going to hurt my put spread almost as bad or just as bad on the downside, all right? So the way you're setting this up, you're able to isolate theta and volatility, so you don't have to worry about those so much. You're just worried about making sure you get that credit for it, all right? Does that make sense for everybody so far? Because I don't know, you're not commenting other than saying looks strong and stuff. Throw some comments out there, folks. Otherwise, I'm going to wrap it up. Before you go, smash that like button. I've mentioned comments a couple of times, but one thing you guys haven't heard is subscribe. Why subscribe? Really only because that little bell right down there gives you an indication when I pop in here unannounced. For instance, I do spot the trades where if I find a trade or I find a market move and I think you need to talk to you folks about as an opportunity, I'm going to pop in onto YouTube and just start talking. And if you guys want to get that content, make sure that bell is lit up right next to the subscribe button, because that will tell you when I'm unannounced. All right, here is the link. I'm going to throw it over in the side here for you so you don't have to worry about it. Thank you very much. I appreciate the kind words, John. I threw a link over there for you guys to hit that hot link, and you guys will go straight to this. 15 hours of content, our videos. You'll be able to tell when you're done with them. It checks them off, stuff like that. Trading that market profile, that's that blue stuff off the, actually I should say the blue stuff that was off to the side of my chart there. And then really understanding when, where, and why we're using those. I go in a little bit more detail in some of these videos there. Also in there, I think, rising interest rates. You guys watch the 10-year lately? 10-year is cracking, right? And I've talked about this for months now, that you folks need to get ahead of this game before it starts showing up in your portfolio, because nobody looks over there at that bond portfolio. They just look over the overall value of a portfolio, look at my stocks, they're up. Why is my portfolio down so much? It's bonds. Most of you guys are not paying attention to those 401k bonds and stuff like that. I've showed you guys ways that you can counteract some of that stuff. Eric, is it best to put on these credit trades in high volatility market? I prefer higher volatility markets for when you're collecting a credit, low volatility markets when I'm paying a debit because I know I'm buying cheap then and selling expensive. With this, I'm kind of middle of the road. I'm a little confused as to if volatility is going to go higher because of earnings or continue to kind of slide out because we get stuck in this sideways market, and that's usually when we see volatility coming up. So I'm a little bit, if one is a little bit confused about the directionality of this volatility, this would be a good trade to start implementing around that. And guys, you're only getting it for $36, which is like a 36-cent option. Anyway, with the multiplier in there. All right, so for $36, this is a little bit more detail as what you're getting. If you guys aren't trading around a bond portfolio and you have a 401k, and I just did this bond portfolio thing not too long ago, it probably cost you that $36 already. And whoever paid for that $36 video, just for protecting your portfolio, is probably very happy with me. All right. I've been having some success with broken call and put flies on Amazon and Tesla. Yes, I do like the broken wing flies for sure when you're doing those directional moves. I'm glad to see somebody's implementing those, though. Those usually get kind of brushed by the wayside. Let me know what you think of the Toro Loco, too, when you try that out. Because it gives you a little bit of wiggle room to, be right. So that's what I love. I mean, I know I'm not always right on my directional moves. I look for those setup candles. They aren't always going to work out. Sometimes, like you saw, they blast off the other way. Wait for those confirmations for some of you folks that are newer to trading that. Hey, if you have any questions, comments, or anything else, folks, reach out to us at trading@to-trade-options-like-the-wolfman. Or if you want me to cover videos on something, I really appreciate anybody's comments because it does help drive what we're going to do in the future. So please reach out to us, and you can call us at 310-598-6677. Thanks, Cam. I appreciate all the kind words out there. Everybody sticking around for the full duration. Love it. All right, that's it. I'll let you go with that, but don't worry. You can always reach out to me at Pro Trader Strategies, trading@protraderstrategies.com. All right, thanks, guys. Appreciate you. Have a great rest of your trading week. And if you can't take that, take it easy.